Hello. You're watching Oil and Gas Investor, which means it's time to discuss the most important developments in oil and gas markets and the stocks of energy companies. In today's episode, U.S. natural gas prices surged by 70% in just 1 week. Where could prices head next week? As promised, we will present our traffic light indicator, which helps assess the direction of gas prices. The U.S. is building up military forces around Iran. We will discuss potential scenarios and their impact on oil prices. Earnings season has begun in the U.S. Companies are reporting fourth quarter 2025 results. What should investors expect, and how should they position themselves? Let's start with the natural gas market. Forecasts of extreme cold weather in the U.S. triggered a sharp rally in gas prices this week. Severe cold increases gas consumption for heating, while simultaneously reducing production due to weather-related disruptions. Over the next 3 weeks, U.S. gas inventories could decline by 850 billion cubic feet, or 28%. During the final week of January alone, withdrawals may reach 370 billion cubic feet, which would be an all-time record. Meanwhile, the situation in Europe, the largest importer of U.S. LNG, is even more concerning. As of January 23rd, average gas storage levels in Europe had fallen to 46.9%, compared with a 5-year average of 61.2%. Since the start of the year, gas prices at Europe's largest hub, TTF, have surged 42%, reaching $13.80 per MMBtu, which is 2.6 times higher than prices in the U.S. So where do U.S. gas prices go from here? Bullish factors include extreme weather conditions and low European gas inventories. However, the key driver next week will be the expiration of the February U.S. gas futures contract, which is likely to push prices lower despite the cold weather. The U.S. Department of Energy forecasts a 15% decline in gas demand in March versus February. This implies that March prices should be significantly lower than current levels. As consumption typically declines in spring, gas prices could fall by up to 40% from current levels over the next few months. Now, let's turn to the oil market. Last week, WTI crude oil prices rose 2.9%, with prices jumping 3% on Friday, reaching weekly highs. In our view, this rally was driven by expectations of potential U.S. and Israeli strikes on Iran. While we do not know whether Donald Trump will ultimately authorize military action, the probability of such a strike increased this week. The U.S. and its allies are strengthening offensive military capabilities in the region and deploying air and missile defense systems. Several scenarios are possible. In the first scenario, no military action occurs. The U.S. maintains pressure, and a deal with Iran is reached. Key U.S. demands include halting Iran's nuclear weapons ambitions, stopping discounted oil sales to China, and imposing strict limits on Iran's missile program. In the second scenario, a limited strike lasts up to 1 week. Targets include air and missile defenses, IRGC facilities, and missile and drone production sites. Iran's response would be limited, and oil and gas infrastructure would not be affected. In the third scenario, a full-scale military operation lasts several months. This could significantly reduce Iranian oil production and exports, damage oil and gas infrastructure, and disrupt shipping through the Strait of Hormuz. Under the first scenario, oil prices could briefly rise to $65 to $70 per barrel before falling toward $50 once sanctions relief discussions begin. The second scenario could push prices to $75 to $80 per barrel in the short term. The third scenario could send oil prices above $100 per barrel, which is why we consider it unlikely. Given the extremely high uncertainty, we cannot forecast oil price movements for next week. Now, let's look at energy stocks. Oil field service companies have started reporting fourth quarter 2025 results. Results from SLB and Halliburton were weak. Revenue growth at SLB was driven by the ChampionX acquisition, while adjusted earnings per share declined year over year. management at both companies guided for lower revenue in 2026, particularly in North America. Despite this, energy stocks are trading at multi-year highs, ignoring weak oil market fundamentals. So what does this mean for our portfolio? We expect natural gas prices to decline by around 40% over the coming months, which prevents us from adding gas producers for now. Oil producers, oil field service companies, and refiners are also very expensive. However, a potential strike on Iran could push prices even higher, creating attractive short-selling opportunities. Oil field service stocks, in particular, look especially interesting on the short side. If you found this analysis useful, don't forget to like the video and subscribe to the channel. We publish weekly insights on oil, gas, and energy stocks, with a clear focus on fundamentals, geopolitics, and market positioning. See you next week.